Hello and welcome to Investors Hangout, your weekly guide to making smarter financial decisions. This series is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, if you've just started earning or struggling to manage your debt or are, wondering how to save and invest wisely, today's episode is for you. We have with us Dhirendra Kumar. Welcome, Dhirendra.
Thank you.
And today we'll discuss we'll break down with Dhirendra Kumar how you can manage your finances effectively. Dhirendra, first up, how can millennials start investing early even if they are not earning much or aren't able to save much?
One is that it's very important, and the other is that it's very difficult.
Right.
It's very important because only in the initial stages you can form the habit. Once you get into the habit of spending beyond your means, it's very difficult to reverse it. You think that is the way of life, and which means that you have already spent what you are going to earn. You have spent your future income. So one is to reverse this particular aspect. Second is that, the magic of compounding, which we keep talking about, that doesn't get triggered for a couple of years. With great, with great dedication and compromise and, all kind of sacrifices, you will be able to save 5,000 rupees a month. And after full year, it will be, you would have contributed 60,000 rupees. And then if you are very lucky, it would have become 67,000 or 70,000 rupees. 70,000 rupees is a very sizable money, a sizable return on 60,000 rupees. But it will not really excite you. The real magic of compounding gets triggered once, couple of years, and then you find that, you have money which you never had in the first place. And then the return on that is translating into so significant, so sizable, that it will look like, okay, you worked all this month and you earned this much and your investments grew that much. That is when the magic starts getting demonstrated. Yeah. And that is very important because, if you don't do that, we are going to live in a very difficult future.
Now, for millennials, what are some of the best ways to balance managing debt, create an emergency fund, and start investing at the same time?
One is that, the first step in that direction is to be conscious of what all you owe. Before you start working towards owning something, before you start investing something, it's extremely important for you to understand that what all is your liability. Because most people don't even have a sense of it. And what is the cost of that liability? Because you might have a credit card debt, which is the most expensive debt that you can have. And no brilliant investment will ever generate the kind of return which you will end up paying. The understanding of this is very critical. Second thing is that, your consumption. Then there are two kinds of consumption. One which goes towards, creating some asset incremental. Or, it is buying an asset which is saving you from something. So if you buy a home, if you buy a house and you're paying the EMI, you have borrowed money and it's a long-term borrowing. And it has started saving you money from right now. On account of rent, or you have started earning rent, and the price of the house will also appreciate over a longer period of time, hopefully. Not necessarily, that is very important. So if it's very important that young people thinking of buying a house should also think and evaluate in terms of occupying that house, so that the payoff is higher. Third is that, some of the discretionary, random, impulsive spending that we do, resist some of those temptations, because that is what will prevent you from building, this habit, accumulating, and just having this roster of your liabilities and seeing that what was most important thing and what is the cost of each of it. You will be able to phase out, and moving in that direction, I think, is a very crucial step, because you become financially savvy. Because to invest, you need to save. And this is the direction which will take you towards savings.
All right, that's about...
Without saving, investing doesn't begin.
Right. So that's about managing debt, essentials.
Sequencing it, which is the one which you should not have it tomorrow if you have the money. The one which you should eliminate immediately. And then, there is always one problem where that is another impediment in getting started, that it's very easy to spend, very difficult to save. So we naturally find excuses very conveniently. There are a lot of procrastinate, and there are very sincere, genuine excuse for not doing it. And one of the excuses that I'll figure out what to do, I don't know where to invest. I think it's very important to get started anyway. If you can't do anything, do a recurring deposit. You don't need to choose anything. Because most important thing is to start taking things out of your normal scheme of things and putting it away.
And begin right now.
Yep.
Okay. So how should millennials approach long-term financial goals like retirement planning when juggling multiple short-term priorities?
I think you need to get disciplined over a period of time. It won't happen in the first day. I think for most millennials, first 2-3 years, if you are able to acquire this much of understanding that borrowing costs money, borrowing to spend is different from borrowing to acquire assets. Then having the essential emergency fund will help you gain dignity. Being financially independent is crucial, and that will help you be more confident, be sure of yourself. I think that is the first step. Then in 2-3 years, if you are able to figure it out, it is all about educating yourself, sensitizing yourself, and very fortunately, you have all the resources to figure it out.
Right. Now, you did mention that, start investing right now, be it a RD that you start with, but what are the investment options that you would recommend, considering that someone doesn't want to start with RDs and, really would like to invest in mutual funds? What are the investments that you would recommend, and what are those common mistakes that one must avoid?
No, one common mistake is that you keep waiting to figure out the best one. And there is never a best one. It is always the right one, which is the appropriate one for you. The world of investing is very complex. But you can dissect every investment into at least 3 variables. One is how risky it is. What is the return potential? Can it beat inflation? And third is how liquid it is. So when it comes to, and everything is a combination of, you look at recurring deposit or a fixed deposit or a government bond or a company's bond or a company shares or a mutual fund or a balanced fund. It is basically the combination of these 3 things which keeps changing.
Right.
When you look at an equity, when you look at a share, it can go up and down a lot. It can potentially give you a lot of return. It could be very risky if you are thinking for the short run. It could be fairly rewarding if you are thinking for the long run. When it comes to liquidity, most stocks are very liquid. At least for an individual, the amount of investment that we make, for few lakh rupees, few million rupees, most shares can be sold in one day itself. So liquidity is high, risk is very high in the short run, risk is reduced over the long run, and return potentially could be higher if you are a little careful about it. Equity mutual fund, it moderates your return and it moderates your risk. Because it's a diversified portfolio, some will do well, some will do exceptionally well, something will do average, something will do poorly, and all of it put together will make it a reasonably better, decent option. When it comes to return, it will moderate your return as well. Then comes, fixed deposit. So fixed deposit come in different format. You go to the government, post office. It's absolutely safe. And it gets you a reasonable return, but it's low. And it's all taxable. And liquidity depends, whether it's a deposit or whether it's another kind of savings account or some such thing. So it's a combination of these 2-3 things. I think there are plenty of options, but you can simplify it. One is that your emergency money should ideally lie in one of the 2-3 things. One is that it can well lie in your savings bank account. If it is getting you 4% and more on your savings bank account, that is the purpose of emergency fund, that you can access it anytime, and it is not more than 5-6 months of your salary. Second is that if you are a little more sophisticated, put your money in a short-term debt fund. It is possible to move your money from your bank account to a short-term debt fund online. And then it will start earning 7.5% or something like that. So that money you should not look at it from a maximizing return. That is the money which should lie there, earn something, accessible, and it will not go down in value substantially ever. Then comes medium term, the money that you need in 1 or 2, 3 years time. That is dependent on how negotiable is that goal. If your child is getting into the school, then you definitely should be taking a slightly different view. It should be in the debt fund only. If you are looking at going on a holiday which is little flexible, can go after 2 years, can go after 3 years, but it's a big sizable investment, maybe consider consider a fund with 20-30% into equity, so that it can optimize return. Substantial part will still be stable. It will not go down in value. And that way you will not get a bad surprise. Maybe it is a nice accumulation vehicle. The money that you don't need for 5 years and more, that depends, that should be invested in equity. It should be entirely into equity. Which kind of equity is also, dependent on how experienced you are. If you have gotten used to the market, invest in there are 2-3 ways of doing it. You want it in a low maintenance way, buy a flexi cap, multi cap or tax saving fund, and that is it. You want to maximize return. You want to lower your expense, and you are inclined to a little complexity you can deal with. Maybe, buying 50% into a lowest expense index fund, another 20% into, small cap fund, another 20% into a mid cap fund. And likewise, by putting in another the residual 10% into a multi cap fund, and that's it. You have broad exposure to the equity market. It is low expense. It has potentially higher return, and all of it. And all this money should be done accumulated by way of SIP, so that you are averaging your return and you are not getting nervous. And that is what I'm saying, that, but primarily long-term money should be in equity. Short-term money, very important money, should be entirely into fixed income. The money in between can have a mix of equity.
Since we're breaking it down step by step, can you also suggest some of the financial tools or apps that are easily accessible and can make investing easy for individuals?
I'll give a disclaimer that we run Value Research Online. That is where you are watching, and Value Research Online enables all of it. You have excellent tools. You have excellent information. In fact, we are the oldest source of mutual fund information in the country, and most other fintechs also take data information from Value Research to show it on their website. So you can use the tools here and monitor your investment. I think I can proudly claim that Value Research Online has an outstanding portfolio tracker. It not only tracks your investments, it easily assimilates. You can just put your PAN number, authorize it with your phone, the OTP that you get, and it will be able to set up all your investments with the historic thing on Value Research Online. I track my family's investments on Value Research Online. I'm the most intense user of Value Research portfolio. And it not only looks at your investment, it helps you analyze and make sense of it, what you should do, what you should not do. Besides that, there are plenty of, you have the Grow application or Zerodha or Cred, where you can look at how you are spending how you are using your credit card, where you are spending your money. But most banks are also enabling, the kind of dissection of or segmentation of your expenditure. I would imagine that, in coming times, it is very important to understand, not knowing what you are doing takes you to a risky territory. Little comprehension of what exactly are you doing, because many times you will be surprised that, okay, you spend this much money on eating out, this much money on traveling, but because all these expenses happen so gradually that these sweet expenses you don't note.
All right then, Value Research Online can help you plan your investments better, and hope this session will also help you moving in that direction. Now moving on to viewers' question for this week, Ranjit Kumar has sent in this question. He says, I'm a big follower of your videos and would like to thank Dhirendra Kumar for his guidance. He has a query regarding his portfolio. His 100% of equity is split like this in his portfolio. He says 50% flexi cap, Nifty 100 index 15%, 2 mid cap funds 25%, small cap fund 10%, and annual contribution to NPS is 80,000 rupees and 1,20,000 to PPF. So he wants your advice on the allocation and if it has to be rebalanced in any way.
He has given a very detailed breakup of where his equity money is. But he should also understand that his NPS money is as much, it's a balanced fund. Maybe 75% into equity, or could be 15% into equity. I don't know which plan he has, or whether he's a government employee and things like that. So it is very important for most individuals to look at all their investments holistically. PPF and NPS is very much your financial investments. Of course, they come with a liquidity constraint that, all your money will be locked in NPS, which is a good thing. But this 2 lakh rupee going into NPS and PPF is what percentage of your total? Because 100% equity is one aspect, but whether the other investments in equity fund is just as much or 3 times as much or 5 times as much, I don't know. So one is to look at it holistically. Right. And this is also where Value Research Online comes into play. You can put all your investments, including NPS, including PPF together, and you will get a holistic view. That's one. Second is that whether it is an appropriate plan or not, if you are a young person, or by young person in the investment context, I'm saying that if you are less than 45-year-old, you still have 15 years to go, then make sure that this 2 lakh rupee going, you have at least you at least have 4 lakh rupees going into equity funds. Okay. So that it is substantially equity and nominally fixed income. Right. If you have crossed 55, then I would say that maybe it could well be half, half in equity, half in debt. And if you are nearing a stage of accumulation where you will start, you expect you need to derive income from it, then it should become equity or fixed income, tilted to your needs, basically. How much do you need in your retirement, or how much income you need to derive from those investments, and that's it. So it requires more precise planning. You need to develop a holistic view and think in terms of how much money you need from your investments and plan accordingly.
All right. Well, that was a great session. Thank you.
Thank you.
Well, don't forget to subscribe to our YouTube channel if you like our videos. Take care. Thanks for watching. Bye for now.